We saw some of the biggest names in the tech world pulling back, even as one of their behemoth peers staged an impressive rally. But the most eye-catching moves were undoubtedly in the raw materials, where precious metals and energy assets experienced substantial downdrafts. This isn't just noise. These are critical signals about underlying economic currents and evolving investor sentiment. All of this, of course, is playing out against the backdrop of a new era at the Federal Reserve, an era that promises to reshape market expectations and, indeed, the very cost of capital. We have a lot to unpack. The financial world is keenly adjusting to the new reality. Kevin Warsh now at the helm of the Federal Reserve. His appointment marks a pivotal shift, and markets are already beginning to price in what they perceive as a more disciplined, perhaps even hawkish, approach to monetary policy. While Warsh's direct policy signals are still nascent, the market is an expert at reading between the lines. This evolving Fed stance is already influencing everything from bond yields to commodity prices. Elsewhere, we heard from J.P. Morgan's Jamie Dimon, who issued a stark warning about the potential economic disaster should certain political proposals regarding credit card caps come to fruition, a clear indication of how policy debates beyond the Fed can ripple through the financial sector. Larry Fink of BlackRock offered a broader philosophical take, questioning whether capitalism, and even the rise of artificial intelligence, is truly spreading wealth equitably. Meanwhile, the tech world saw Elon Musk's ventures, SpaceX and XAI, combining to a staggering valuation, highlighting the immense speculative capital still flowing into transformative technologies. And Jensen Huang of Nvidia, ever the people's dad, continued to push his suppliers, underscoring the relentless demand and supply chain intricacies within the AI sector. All these voices contribute to a complex mosaic of market sentiment and future expectations. The bond market, as always, is providing some of the clearest signals about where smart money believes the economy and monetary policy are headed. Today, we saw the yield on the benchmark 10-year Treasury note move higher. This rise isn't happening in a vacuum. It reflects a confluence of factors, not least the recalibration of expectations surrounding the new Federal Reserve leadership. Higher yields typically suggest investors are demanding more compensation for holding government debt, often due to concerns about persistent inflation or anticipation of tighter monetary policy. The "wrong again" headline about inflation forecasts missing the mark is crucial here. If inflation proves stickier than experts predict, then the Fed, under Chairman Warsh, may be compelled to maintain a firmer stance for longer. Compounding this uncertainty is the delayed U.S. jobs report, a critical piece of economic data that now leaves a vacuum for the Fed's decision-making process. The market hates uncertainty, and these delays only add to the speculative pressure on yields. Furthermore, headlines pointing to a historic Treasury short building up suggest that a major shift in Fed policy could indeed trigger significant movements in this critical market, creating both risk and opportunity for those who can anticipate the next move. The focus of the financial world is firmly fixed on the new era at the Federal Reserve, now under the stewardship of Chairman Kevin Warsh. His predecessor's approach, often characterized by a more dovish tilt, has given way to an expectation of a more orthodox, perhaps more hawkish, stance. This shift isn't merely theoretical. It has tangible implications for everything from interest rates to the pace of quantitative tightening, if and when that resumes. The Senate's recent passage of a spending package, even with the looming threat of a partial shutdown, adds another layer to the fiscal backdrop against which Warsh must operate. He inherits an economy grappling with persistent inflation, a tight labor market, even with delayed data, and significant government debt. The Kansas City Fed's research on the natural rate of interest offers an academic framework, but Warsh's practical application of policy will be the true test. How he communicates, and how the market interprets his initial signals, will be paramount. Across the Atlantic, the European Central Bank, under Christine Lagarde, continues to maintain a cautious stance, typically avoiding forward guidance on future interest rate decisions. Similarly, the Bank of England's upcoming meeting holds significance for UK inflation and interest rates. However, for the US market, all eyes are on Warsh and the anticipated clarity of his vision for America's monetary policy. Today, the commodity markets delivered some truly dramatic moves, serving as potent indicators of deeper economic forces at play. Gold, often seen as a safe haven and inflation hedge, experienced a significant downdraft. While today's specific drop was substantial, the larger context points to an unprecedented crash, with the precious metal retreating from record highs. This weakness can be attributed to several factors: the rising 10-year Treasury yields making non-yielding assets less attractive, a strengthening dollar potentially, and perhaps a general recalibration of inflation expectations under the new Fed leadership. Oil prices also tumbled considerably. This decline occurred despite news that OPEC member Iraq intends to make compensatory oil cuts, which in theory should provide price support. However, demand concerns, potentially linked to global growth forecasts or even shifts in sentiment around energy consumption, appear to be outweighing these supply-side adjustments. The most striking move, however, was in natural gas, which plummeted by a staggering margin. This extreme volatility was largely driven by updated weather forecasts indicating warmer temperatures across key demand regions in the US, drastically reducing the need for heating and leading to a significant inventory buildup. These commodity shocks underscore the sensitive balance between supply, demand, and macroeconomic outlook. Looking across the equity landscape, we observed a fascinating tale of divergence today, particularly within the influential technology sector. While the broader tech-heavy Nasdaq 100 showed some resilience, individual components told a more nuanced story. Apple staged a truly impressive rally, surging significantly. This strong performance likely reflects renewed investor confidence, potentially on the back of positive analyst reports, robust demand for upcoming product cycles, or strong international sales data that we are still digesting. In stark contrast, other tech giants such as Nvidia, Tesla, Microsoft, and Meta platforms all experienced pullbacks. This suggests a rotation within the tech space, possibly as investors re-evaluate valuations in a potentially higher interest rate environment under the new Fed chair, or perhaps a shift towards companies with more predictable cash flows and less dependency on future speculative growth. The financial sector, represented by the XLF, posted a solid gain, often a positive sign for the broader economy and potentially indicating an expectation of higher net interest margins for banks in a rising rate scenario. Conversely, the energy sector, following the sharp declines in oil and natural gas prices, naturally faced headwinds, reflected in the significant drop of the XLE ETF. This sectorial snapshot paints a picture of a market actively repricing opportunities and risks. The digital asset space often dances to its own beat, but today it offered a very specific narrative around a key corporate player. Bitcoin itself showed remarkable stability, holding its ground and trading essentially flat, a testament to its recent consolidation after a period of intense volatility. However, the corporate proxy for Bitcoin, MicroStrategy, experienced a substantial sell-off, with its shares dropping significantly. This divergence is critical. It suggests that the market's concern isn't necessarily with Bitcoin itself, but rather with MicroStrategy's highly leveraged strategy of holding the digital asset on its balance sheet. Headlines like, "A look at MicroStrategy valuation after Bitcoin plunge tests its leveraged crypto strategy," and "Michael Saylor's high-stakes Bitcoin bet faces fresh strain," indicate that investors are scrutinizing the company's financial health and the potential risks associated with its strategy, especially in a world where the cost of capital may be rising. Ethereum, the second largest cryptocurrency, saw a modest decline, following the broader trend of cautious consolidation in the crypto market. The narrative here is less about the fundamental value of digital assets and more about the perceived risk of corporate exposure to them. As we look forward to the trading day ahead, investors will be keeping a vigilant eye on several key areas, particularly given the evolving landscape under the new Federal Reserve Chair, Kevin Warsh. The first item on the agenda will be any further commentary or even subtle cues from Chairman Warsh himself. The market will be dissecting every word for insight into his policy leanings and the trajectory of interest rates. The delayed U.S. jobs report, whenever it materializes, will be a significant market mover. Its impact on inflation expectations and the Fed's reaction function cannot be overstated. We'll also be watching for any new inflation data points, especially following the "experts missing the mark" narrative. Furthermore, given the dramatic moves in the commodity markets, energy inventory reports and global demand forecasts will be critical for oil and natural gas. Any developments in the geopolitical sphere, particularly regarding OPEC production quotas or unexpected supply disruptions, could quickly reverse today's declines. Lastly, corporate earnings season continues, and any major surprises from key companies, especially within the tech sector, could dictate market sentiment and continue the divergence we observed today. Investors should brace for continued volatility and remain agile in their strategies. Today's market action was a powerful demonstration of a financial system in transition, navigating a new era of monetary policy under Chairman Kevin Warsh. The narrative is no longer solely about inflation, but about the response to inflation and the new Fed's willingness to act decisively. This shift is already manifesting in higher bond yields and a repricing of assets, particularly impacting interest rate-sensitive sectors and, notably, precious metals like gold.